Question 7. How do Bitcoin leveraged ETFs compare to other leveraged instruments like options contracts? Both BTC leveraged ETFs, were they to exist, and options contracts offer ways to leverage your exposure to Bitcoin, potentially amplifying your gains or losses. However, they differ in several key aspects. Structure. BTC leveraged ETFs. These are exchange-traded funds that aim to deliver a multiple of the daily percentage change in the price of Bitcoin. They achieve this by using financial instruments like futures contracts. Options contracts. These are contracts that give the buyer the right, but not the obligation, to buy a call option, or sell, put option, an underlying asset, Bitcoin in this case, at a predetermined price, strike price, by a specific expiry date. Leverage mechanism. BTC leveraged ETFs. The leverage is built into the structure of the ETF. The fund manager uses borrowed money and futures contracts to achieve the desired leverage ratio, e.g., 2x or 3x. Options contracts. Leverage is controlled by the investor through the choice of the option type and the number of contracts purchased. For example, buying a call option with a lower strike price compared to the current price offers more leverage than a call option with a higher strike price. Risk and reward. BTC leveraged ETFs. Losses are amplified by the leverage ratio, meaning a small downward movement in Bitcoin's price can lead to significant losses. The potential gains are also amplified, but the tracking error and decay of leverage can impact actual returns. Options contracts. Losses are limited to the premium paid for the option contract. However, if the price of Bitcoin moves in the opposite direction of your option bet, the entire premium is lost. The potential gains can be unlimited for successful call options, and up to the difference between the strike price and the current price for successful put options. Complexity. BTC leveraged ETFs. While they involve complex financial instruments, they are generally considered easier to understand for the average investor compared to options contracts. Options contracts. These involve more complex concepts like strike price, expiry date, and option Greeks, measures of risk and sensitivity. Understanding these concepts is crucial for making informed decisions with options. Management. BTC leveraged ETFs. The ETF manager actively manages the leverage through daily rebalancing. Investors don't need to actively manage the position. Options contracts. Investors need to actively manage their options positions by monitoring the market and deciding when to exercise or sell the contract before expiry. Suitability. BTC leveraged ETFs. Due to the amplified risks, they are generally considered unsuitable for most investors, especially those with a low risk tolerance and limited understanding of complex financial instruments. Options contracts. These are even more complex than leveraged ETFs and are generally only suitable for experienced investors who understand the risks involved and can actively manage their positions. In conclusion, both BTC leveraged ETFs, if they existed, and options contracts offer leverage for Bitcoin exposure, but they differ significantly in structure, leverage mechanism, risk or reward profile, complexity, and management. Options contracts offer more control and potentially unlimited gains, but also come with greater complexity and risk. Leveraged ETFs are generally considered simpler, but carry the risk of amplified losses and potential tracking errors. Question 8. Are BTC leveraged ETFs suitable for all investors? BTC leveraged ETFs are not suitable for all investors, and in fact, they are generally considered unsuitable for most investors. Here's why. High risk. The primary reason is their inherently high risk. They amplify both gains and losses, meaning even a small downward movement in the price of Bitcoin can lead to significant financial losses that could wipe out your entire investment. This makes them unsuitable for investors with a low risk tolerance. Complexity. These ETFs involve complex financial instruments like futures contracts and strategies, making them difficult to understand and manage for the average investor. This complexity can lead to poor investment decisions and increased risk of losses. Tracking error. Due to the compounding effect of daily rebalancing and other factors, the actual return of the ETF might deviate significantly from the targeted leverage ratio. This means you might not achieve the returns you were expecting, even if the underlying asset price moves in the predicted direction. Decay of leverage. In downward trending markets, the rebalancing process can lead to a gradual erosion of the targeted leverage. This can further amplify losses and significantly impact your returns. Fees. Leveraged ETFs typically come with higher expense ratios compared to regular Bitcoin ETFs due to the additional costs associated with managing the leverage and the use of complex financial instruments. These fees can further eat into your potential returns. Therefore, unless you are a sophisticated investor with the following characteristics, BTC leveraged ETFs, if they ever become available, are not recommended. High risk tolerance. You must be comfortable with the potential for significant financial losses. Deep understanding. You need a thorough understanding of complex financial instruments like futures contracts, leverage, and the risks involved in leveraged ETFs. Experience. You should have significant experience in trading and investing in volatile markets. Question 9. Can investors use BTC leveraged ETFs for hedging purposes? While BTC leveraged ETFs are not currently available and generally not recommended for most investors, the question of using them for hedging purposes raises some interesting points. In theory, hedging against a short position. One could theoretically use a short position in a BTC leveraged ETF to hedge against a long position in Bitcoin. This means if the price of Bitcoin goes up, the losses from the long position would be offset by the gains from the short leveraged position, amplified by leverage. However, this strategy is complex, risky, and requires close monitoring of the market. Limited effectiveness. Even if the strategy is executed perfectly, the tracking error and decay of leverage associated with these ETFs can limit their effectiveness as a hedging tool. However, in reality, not suitable for hedging. Due to the inherent risks and limitations mentioned above, BTC leveraged ETFs are generally not considered suitable instruments for hedging purposes. There are better and less risky alternatives available for investors seeking to hedge their Bitcoin exposure. Here are some alternative hedging strategies for Bitcoin investors. Regular Bitcoin ETFs. Holding regular Bitcoin ETFs can provide exposure to Bitcoin's price movements without the amplification of risk associated with leverage. Inverse Bitcoin ETFs. these ETFs aim to deliver the opposite of Bitcoin's daily performance. While they offer some hedging potential, they are also complex and carry their own set of risks. Futures contracts. Experienced investors might utilize Bitcoin futures contracts to hedge their exposure. However, this strategy requires significant expertise and involves considerable risk. Question 10. What are some alternatives to Bitcoin leveraged ETFs? Given the high risks and complexities associated with BTC leveraged ETFs, which are currently unavailable, here are some alternative investment options to consider. 1. Regular Bitcoin ETFs. These offer direct exposure to Bitcoin's price movements, without the amplification of risk associated with leverage. They are generally considered less risky and more suitable for a wider range of investors compared to leveraged ETFs. However, they still involve the inherent volatility of Bitcoin and may not be suitable for all risk tolerances. 2. Inverse Bitcoin ETFs. These ETFs aim to deliver the opposite of Bitcoin's daily performance. This means if the price of Bitcoin goes up, the value of the inverse ETF goes down, and vice versa. They can be used for short-term speculation on a downward trend in Bitcoin's price, or for hedging a long position in Bitcoin, but with caution due to their own set of risks and complexities. 3. Bitcoin futures contracts. Experienced investors can utilize Bitcoin futures contracts to gain exposure to Bitcoin's price movements and potentially hedge other holdings. However, this strategy requires significant knowledge, expertise, and risk tolerance due to the complexity and volatility of futures markets. 4. Cryptocurrency investment platforms. Several regulated cryptocurrency investment platforms allow you to buy and hold Bitcoin directly. These platforms offer varying levels of security, fees, and features, so thorough research is crucial before choosing one. 5. Diversified cryptocurrency funds. These are actively managed investment funds that invest in a basket of cryptocurrencies, including Bitcoin. They offer diversification and potentially professional management, but also come with management fees and the inherent risks associated with the cryptocurrency market. Alright, folks, that's all we have on Bitcoin leveraged ETFs for today. Remember, these are complex and risky instruments, and generally not recommended for most investors. Before you even consider them, thoroughly research alternatives, understand your risk tolerance, and consult with a qualified financial advisor. As always, thanks for joining the conversation. Don't forget to like and subscribe for more insightful content on the exciting world of ETFs.